Good. Okay. And here's an example with a company called Baker. Contribution margin. Their unit contribution margin is 10. Selling price is 25. So that means they're making a 40% of the selling price is available to cover the fixed cost. That's the contribution margin ratio. And if we're working from that, we're going to input that here. And here's our sales price, or our fixed costs. And that gives us what we have to do is break even in dollars, 225. But we also need to do that 9,000 units. So we're looking at the relationship between the 9,000 units at 225. Okay, it's math. Now, fixed costs are fixed over a time horizon that I mentioned previously. And when we have a case, we make an assumption of that within a range. But remember, management makes decisions on spending, and these costs can change, and they will. So it's key when we're doing things is to make a series of assumptions of these. And since we're providing information about making decisions, we're going to provide a range of information between this and this so that management can make that decision. Okay? So if fixed costs go up, then the break even goes up. Fixed costs go down, then break even goes down. So management is looking, how can we manage those fixed costs? If we make this decision, how does that impact our break even? And have we moved that line down to increase our profitability? Okay. And when you think about it, unit variable costs generally do not change with changes in the level of activity. Okay, because they're variable and they're based on the actual level of activity. But they can be impacted by other factors. Change in the cost per unit of direct materials. Okay, that'll change. Changes in the wage rate for direct labor. So there are changes that will happen, and when we do modeling, we build those assumptions into our models. But these are the foundations that we're doing now. We'll move forward from there. And these changes happen regularly. Variable costs are not static. They're very dynamic, and we're going to use that word as we move forward. So what's the effect of the change in unit cost on break-even point? Well, if the unit variable cost goes up, the break-even point goes up. Unit variable cost goes down, then break even. So think about it. Management is always trying to manage the costs. Then the third part of the equation, we talked about the fixed cost. We talked about the variable. Now let's take a look at the selling price. Okay. If the unit selling price goes up, the break even goes down. Unit selling price, break even goes up. It's an equation that they all work together. Now, why do selling prices change? Let's just think about that for a second. Competitive pricing. What does a competitor do? If the competitor is higher than us, maybe we can raise our prices. If they're lower, maybe we need to adjust ours within that break-even framework. So competitive pricing. Supply and demand. As these change, so does pricing. We saw that with toilet paper at the beginning of the pandemic. The demand went up. Okay, the supply took a while to catch up. Prices went up on toilet paper, hand sanitizer, wipes. And we can now find toilet paper, we can find hand sanitizer, still can't find wipes. But when you do look at wipes, you're going to find that the price is pretty high. So we have this supply-demand impacts the pricing, but we also have this piece here, the supply chain. Okay, and in the supply chain, costs within any part of the supply chain will impact the company. And that could include, from a distributor, change in fuel costs. Could work its way through the system as prices go up or they go down. But there's this thing down here, okay? If we're looking at this graph, let's do this. Let's take a look at this. It's a little cloudy, but what happens is we have a lot of times we have dynamic pricing. And if we look at this, if you have one price, here's our price on this side, here's the number of buyers, here's the cost, okay, and here's the profit. Now, if I drop the price too low, I left money on the table. I could have gotten that, okay, passed up profit. Now, if you look at, so there's opportunities here to make money within that. So I passed up profit, left money on the table. So the question is, if I can use multiple pricing points, dynamic pricing, my profit range is not just this, but it becomes the incremental piece. So by using dynamic pricing, I can pick up more profit, okay? But I have to be cautious not to get into competitive pricing or getting it that this becomes a commodity that everybody wants the same price. So we can use this in a dynamic pricing situation also. Very simple example here. They're evaluating a proposal to increase the unit selling price from 50 to 60. Okay, so when we look at it, currently the selling price 50, variable cost 30, contribution margin 20, proposed 60, 30, 30, fixed cost. What is going to happen here? Our profit is going to go up. So the break-even point originally was 600,000 divided by 20, meaning we said 30,000 units. The break-even point after price increase is computed as follows again, 20,000 units. So by increasing the price, we are actually going to make more. Our break-even point will be less. That means our profit points can be greater. Let's summarize basically is the type of the change, the direction of the change, and the effect of change on the break-even of sales. So if fixed costs are going up, break-even sales has to go up. Okay, so that if fixed costs go up, you still got to cover those fixed costs. Fixed costs go down, the break-even point goes down. Unit variable cost goes up, break-even price sales go up. Down, down. Now, when we look at the unit selling price, that's a little bit different. If the selling price goes up, the break-even point goes down. Conversely, if the unit direction of change is down for the unit selling price, is up on the break-even. So we got to take a look at those. So once we understand that, and this is fundamental because everything is related. You can't just look at fixed cost, can't just look at unit variable, you can't just use the selling price. You got to put them all together and take a look. The other thing you can do is you can figure out fairly simply how much money do you want to make. So you can target your profit in this point. We would say we want to make X dollars. So we already know what the break even is. So if we take the fixed costs plus our target profit divided by the unit contribution margin, which is expressed in a percent, we'll be able to get the number of units we need to sell. Okay, so now we're trying to plan profit. So at this point, this example, the fixed costs are 200 and we want to make 100. So the unit selling price is $75 a unit. Our variable cost is 45, so the unit contribution is 30. So we take this, to find out the sales unit, we take the fixed cost here, 200, 200, plus 100, divided by 30, which is the unit contribution margin, and we need to sell 10,000 units. Now, if we work back from that, we can also need the 750. Okay, we can also turn this into a dollar amount using some of the same numbers. So we start with the contribution margin ratio, which is the unit contribution margin, 30, divided by the unit selling price, 75, gives us 40%, the ratio. So if we take our fixed costs plus our target profit, which is 200 plus 100 equals 300, we divide that by our contribution margin, and that gives us sales would be $750 in dollars. So if we're looking at this, we can compute it based on units, and we can compute it in dollars. So a lot of times we're going to be going back and forth between units and dollars, so you want to make sure you're thinking about it in that context. Important not only in our day-to-day work, but when we have quizzes, you're going to see that you want to pay close attention to exactly what I may be asking. When we look at this, our cost volume profit chart, and we can start to see these different things, our break-even point, we can see is 5,000 units at revenue of 250. Everything above that, given that expenses behave the same as they have, we'll see that going up. So that's our cost volume profit. So we really want to be in this area right here. Now, I'm not going to walk you through this, but these are the steps in the process to construct that chart. Again, you may wish to take note of this. Okay, let's take another example of this. Fixed costs are 100, selling price 50, unit variable cost 30, margin of 20. And let's assume they now want to reduce those fixed costs by 20. So that fixed cost would be 80. So what we've done is we've brought the break-even point down because we reduced our expense, fixed cost expense. So what you've seen is we're here, by reducing expenses, we bring it down here. So we can be more profitable at lower costs. This should be a no surprise to anybody, but these are the types of graphs and what we would do to support a business unit. And what we can then do is create visuals. Once we know some of that, we can then take a look at what our operating loss profit would be relative to the units of sale and say, where can we maximize our sale, our profit, okay, and what do we got to be cautious of? So we can make different decisions around that to maximize profits. At the same time, in the middle of COVID-19, we may be down in this area, so we may need to recalibrate how many units, but also what our costs are, so that the break-even point or profit stays above. And again, I've listed the 5 steps. I'm not going to go through them here. You can read. So take a look at them. One of the things that I want to stop at a moment here and just take a look at this. What have we done? Well, we've often used graphs in data, but this is the new reality. Data visualization is a really big topic, and it's we've got so much data, and to be able to present it in a way that's understandable becomes very useful. So you could give me a whole stack of numbers, but if you can show me a little chart that tells me everything I need to know, I'm more efficient as a manager, as a leader, and I can use that information more. Why do I need the information? To make decision. And I got to gather facts, okay? And then I'm going to brainstorm pros and cons, decide, follow through, and define clarity. Plan, do, check, act. So what I'm always going to be doing is looking at this data and it becomes part of the decision-making process. So that ends video number 2 on this, and we're going to get a little more specialized in video 3. If you have any questions, please let me know.